VA home loan assumptions. There's been a lot of talk about this lately, so today we're going to talk about the good, the bad, and the ugly of VA loans. Everybody, welcome back. If you haven't got an opportunity, please like and subscribe to us so we can keep good information coming out for you. So, VA loan assumptions. This is a great tool that's also very rare amongst loans. VA loans are one of only two loans, VA and FHA loans, that actually allow what assumptions are. What that means is someone can come in and assume a VA loan at a low interest rate that current seller, that current veteran has on their VA loan. So let's talk about some of the pitfalls of this and why it's not always sunshine and unicorns that you hear about, and there's a lot of misinformation out there. Number one is the speed issue. VA loan assumptions, unfortunately, are not fast. As a matter of fact, last year, the average time it took to get an assumption done was about 60 days. Here's the thing, they don't always get approved either. As a matter of fact, around 14% or so of VA assumptions would be declined. So there's no guarantee that the person trying to assume that loan can get all the way to the end of that process and not get approved for that assumption. The other big thing is the entitlement and liability issue. This is another big one that a lot of veterans aren't aware of, unfortunately. Now, if you have a non-veteran come in, because a non-veteran can actually come in and assume a veteran's VA loan at that nice low interest rate, however, that remaining entitlement that the current veteran has, the seller of that house, is going to lose that entitlement. Another caveat to think about too is they're on the hook. So in the future, if that person unfortunately defaults on that loan, has a foreclosure or a short sale, that's going to show up on the veteran's certificate of eligibility that they had a loss on a previous VA loan. It's not going to impact their credit. It's not going to show up as a foreclosure or a short sale on their credit report, but it is going to show up on the certificate of eligibility that they did have a foreclosure or a short sale. The only way around that is in the future, if the veteran wants that entitlement reestablished, they have to pay back to the VA whatever that entitlement was that was lost. So that's something to think of with that. Now, if it's a veteran assuming that VA loan, you have a couple of different options. That veteran can assume that loan, however, they have the option of using their own eligibility. So that frees up the eligibility of the veteran that's vacating that property of the assumable loan. The other big issue is the lender issue. It's the actual current servicer of that VA loan that has to approve the assumptions. Not all lenders do that. A lot of lenders that have the serviceability on that loan, they want to keep that serviceability, especially if it's a really good performing loan. They might want to not take the risk of putting that out there with a new borrower. So that's something to keep in mind as well with that. So finally, another thing that you want to think about too is there is a big gap between what the loan is that's being assumed and the sales price of the home. A lot of times people think, oh, there's this $300,000 loan on a VA loan that I'm going to be assuming at a beautiful 2.75% interest rate. However, the sales price of the home is $500,000. That means the person that's coming in to buy that home and assume the loan has to come up with the difference in cash. The last time I checked, there is no seconds that are allowed to go along with that VA loan because that second is not assumable as well. So, for example, if it's a $500,000 purchase price and the assumability on that loan is $300,000, the person buying that home and that's assuming the loan has to come up with a $200,000 down payment. So those are just some things to think about. If you're looking to do assumption, you want to check with the current servicer of that loan. That means that's the servicer is the bank that is actually taking the payments that are being presented to the seller in that. So that's something you want to think about. Not all lenders, not all servicers will approve assumptions. The other thing is the down payment. You know, is it a big enough gap to where it's going to make sense or not make sense? The other thing to think about too is people are not starting over. So if someone bought a house in 2020 and that interest rate is 2.75%, that person's not assuming a brand new 30-year VA loan. They're assuming the payments and the amortization at the 25 remaining years. So those are some things you want to think about. It's a great idea in principle. However, if you're a younger veteran, I do not advise whatsoever in having your entitlement used up against you. So you want to make sure you're asking the proper questions. One, is it a veteran that's assuming the loan? And if so, are they willing to use their own eligibility to replace yours? Two, if it's a non-veteran, that eligibility goes away. You don't have access to that eligibility in the future. So in the future, if you want to use your VA loan again and buy another home, you got to keep in mind that eligibility is gone. You also have the risk of possible defaults and that affecting your certificate of eligibility and how much eligibility you have in the future. So I hope that helps. Thanks for watching. Again, if you haven't already, please give us a like and subscribe, and we'll talk to you soon. Have a great day, everybody.